But first, let's welcome our first guest, Logan Mohtashami. He's a financial writer and blogger covering the U.S. economy and specializes in the housing market. You can find his work on Business Insider, Benzinga.com, and his own highly respected blog, The Financial Truth. Logan, thanks for joining us today.
Pleasure to be here.
You know, Logan, I've been doing some research on you, and you really are a student of the macroeconomic data. I've been to your website. You follow all the trends in the economy and housing. But the one question I have for you today, and I've got a series of questions, and I look forward to your answers. We see debt rising faster than GDP. How long can we keep up that pace?
We're going to keep up that pace for the rest of this century. I forecast federal debt going to $71 trillion by 2060. And I don't think it's going to be a problem if we allow most of the debt being transferred as transfer payments to older Americans.
Well, that's an interesting number. I will tell you, though, with the rise of the extreme right and the rise of the extreme left, the political economic spin will be, we can't spend the money or we can spend the money. How are we going to pay for all of that? I mean, are we going to be just putting up money continuously to do all of that? Because the budget shortfall would be enormous. That's 5 times the size of GDP practically. How can we pay for all that?
And we haven't been paying for it for a very long time. If you actually go back to many decades, federal debt has been rising, tax rates have been falling, and we've been borrowing at very low rates. So I think the benefit of the U.S. economy being the biggest economy in the world, having the biggest military, being the wealthiest nation in the world, we'll always get top notch in the bond market, and the U.S. dollar will never lose its currency. So we're just basically going to print our way to that $71 trillion of debt.
Well, I think you're probably right there, but I think if we go there to the $71 trillion number from the $22 trillion we're at now, excluding the Medicaid and Social Security liabilities we have, we're going to see 0% interest rates for a long time. We're going to be like a Japan model. Wouldn't you agree on that?
We are basically heading towards a Japan model. Japan's debt to GDP is actually 250%. So, and they have a dying population. We have prime age labor force growth for the rest of the century, not very strong like it used to be, but we have enough that's much better than China, Japan, or Europe. So our currency will stay the top notch for the rest of the century.
Well, fortunately, we don't have the secular demographic problem that Japan has because they're not procreating over there. Their population is dwindling, so they have a shrinking dynamic for their economy. All right, so on that note, what do you think is going to happen with interest rates in the short term? We see a flattening yield curve now. We saw it invert partially here. And do you think that's indicative of a recession?
No, and I stayed consistent with my calls over the last 6 years. I've said the 10-year yield will be between 1.6 and 3% majority of the time, and it has been. I don't think we can break away too much from 3%, especially with trillions of dollars of negative yields around the world out here. So unless oil prices really take off and stay up higher, which I don't think is a possibility anymore because our production levels are high, I think interest rates will stay low for a very long time unless we really create some domestic demand with domestic spending that creates wage inflation or companies really fighting over labor. So I think we could stay in a low interest rate for a very long time.
All right. Well, I appreciate that insight, Logan. I think you're spot on. So tell me what's happening in the real estate market very quickly here. We've got about 30 seconds. What do you think is going to happen with real estate this year? Are we going to see declines or increases?
Existing home sales should be negative. There are going to be parts of the U.S. where you're going to see year-over-year declines in home prices. On an adjusted to inflation price level, we should have flat to negative prints on a year-over-year basis this year. But on a nominal basis, real estate should still be growing. I'm looking for total sales to be between about 5.6 to 5.8 million existing and new home sales together. So a down year in sales, but not too drastic.
All right, Logan, don't go away. We'll be back with more right after the break. I'm Jeff Small, and you're watching The Income Generation. Right now, let's welcome back financial writer and blogger Logan Mohtashami. Logan, thank you for sticking around.
My pleasure.
So, Logan, I take a Warren Buffett approach when I look at the real estate sector, and I kind of get a feel for what's going on locally and regionally in my area. And some odd numbers popped up recently when I did that. I found that listing expirations were up over 400% year over year, and we're in Florida in a great market. A lot of the home builders in the area were down 25% year over year in terms of what their revenues are. So I think the impact of the slowdown in real estate is much larger than anybody has yet to realize. And we saw that dynamic yesterday in the earnings numbers for Lowe's and Home Depot over the last couple of days when their earnings came out. I did speak on one of the major networks on that. But the reality is, I think real estate's going to slow down substantially more than anybody realizes. And so what do you think will happen on a worst case scenario with real estate? If it really slows down and consumer spending is truly falling off right now, we see a decline in restaurant purchases, unlike we've seen since 2008 and 2000, a decline in consumer spending during the holidays, everything seems to be basically stagnating or faltering. The consumers are pulling back. And so how big of a pullback do you think we're going to see with consumer spending across the board?
I think consumer spending is going to hold up fine. I think with real estate, what we already have, we actually have enough data to get a heads up of what we're going to look like in 2019. You could see that in the purchase application data. We're actually at cycle highs with the purchase application data on a year-over-year basis, but we do have some negative prints this year, which we haven't had since 2014. But in 2014, when existing home sales ended the year at 4.9 million, we were actually down 20% year over year consistently. This year, we've had 4 positive prints and 3 negative prints. The positive prints have been higher in a percentage basis. So I think real estate's going to hold up, but I do think we're going to have, existing home sales stay between 4.9 million to about 5.3 million. So it will be a decline, but we ended the year last year at 5.34 million. So we might lose 100 to 200,000 home sales at worst.
So you don't think we're going to see a correction in real estate like we did in 2008 and 2009, I take it?
Absolutely not. What the big difference between this cycle and the previous cycle is this has been the weakest new home sales cycle ever recorded in U.S. history. And existing home sales, if you look at the sales and purchase applications, we're not even at 21st century levels yet. So it's very hard to have a bust when you don't have a boom. I think the peak sales rate for existing home sales in 2005 was about 7.2 million. The last print came in at 4.94. So it's really hard to have this crash when housing demographics is about to have its best boom in many decades in terms of we have a lot of people ages 25 to 31. While the housing institutions will call this a boom about to happen, I look at them as more as replacement buyers. So the demand will stay at bay for probably a decade here.
Huh. I kind of feel the same way. I don't see real estate correcting this time. I see it actually going up from here. I think if we're going to have a recession, it would be short-lived, and we might see maybe a 10% correction in real estate. The upper end priced real estate, like the homes are valued more than $750,000 to $1 million or more, those seem to be having great difficulty today. And so tell me what you're seeing in the higher end markets.
Yeah. That's exactly right. California is looking, it's going to have its worst sales year since 2008. Seattle is having problems on the higher end. New York is having problems. Those markets get a lot of attention, but they're just small parts. The entire U.S. as itself, you get away from the coasts where interest rates are right now, it's not that bad because adjusting to inflation, home prices aren't back to the peak levels yet. So in middle of America, it's parts of the South, even parts of the West and East, home prices with rates where they are not that bad. If we ever got to 5.875% on mortgage rates with what real home prices are right now, there I think would be a noticeable demand decline. But that's not in the card this year, and I don't think it'll be for next year either.
Okay, Logan, that was great info. Stay where you are. We'll be back for one more segment after this break. Now, let's welcome back financial writer and special guest and blogger, Logan Mohtashami. Hey, Logan, thanks for sticking around.
Sounds good.
All right. So, in reality, we see debt across the board is larger than ever, especially consumer debt, corporate debt, federalized debt. It's not just domestic, it's global. We have this debt maximum that we're at. So how much more can debt expand inside of real estate before we come close to that tipping point that we did in 2007? What are the different areas that could potentially prevent a recession in that regard today?
Well, I actually disagree with the notion that consumer debt is a problem, because if you actually look at consumer debt adjusting to inflation, we're actually nowhere back to the previous peak. Majority of the debt is mortgage debt. And mortgage debt right now has never looked this good ever in terms of the quality of home buyers we have in this cycle, and the fact that we've taken off pretty much all exotic debt off the system now. So if you look at household debt versus incomes, we're basically at multi-decade lows. Fixed low debt costs against rising wages. So I'm not concerned about consumer debt in the way that some people have talked about over the years. Because if we look back in the last 8 or 9 years, people always talk about the student loan debt crisis, the auto loan debt crisis, the federal debt crisis. We've had a lot of crisis in this expansion, but what has happened is we have had the longest job expansion ever recorded in U.S. history. We're going to have soon the longest economic expansion ever recorded in U.S. history, with the highest job openings ever recorded in U.S. history. So consumer debt, if anything, it's not strong enough. And with our prime age labor force about to really kick in now, I think debt could expand more in a more modest fashion, and we should be fine there.
Wow. And that's exactly why I think real estate's going to go up. So if the recession's not going to impact home values at this point and the debt level isn't a concern, do you think now is a good time for people to buy homes for the first time, or maybe help their kids get into a house for the first time?
Housing to me is always the cost of shelter to your own capacity to own a debt. So I don't actually ever try to correlate it to an investment or should you buy a house. You're only going to be waking up and going to bed with that total mortgage payment every single day. So you, as a consumer, can only answer that question by yourself. Nobody on TV or a bank or anybody else can tell you that. So if you feel like that total payment and you can make it, and you obviously have to be qualified to even attempt to make that payment, you should be okay. But again, prices, have gone up a lot on a nominal basis. I think there's still some room left, but if you're concerned about home prices, just take a look at the monthly inventory. If monthly inventory starts to head towards 6 months on a national basis, home prices are, most likely going to go down in the following year. On an adjusting to inflation basis, especially if you're looking at the Case-Shiller index, we should see some flat to negative prints. But on a nominal basis, we still have some legs to go up higher right now. When the job loss recession happens, which is not going to happen in 2019, shouldn't happen in 2020 either, that'll create some distressed supply that will raise inventory. But it will be nothing like what we saw during the housing bust, because we actually have a lot of nested equity. There's no cash out boom. There's no recast concerns out there. This is the best home buyer profile we've ever seen in our lifetime. And 20 to 30% of the homes that were bought in the cycle were done with cash. So the amount of distressed sales coming in the next recession will be very small compared to what we saw in the previous cycle.
Yeah, but real estate is slowing down, Logan, because prices have peaked, interest rates are up, and consumers are pulling back and saying, you know what, I think I'm going to wait. It's a little too pricey for me, because homes really have, like you said earlier in the show, are up 50% since 2012. And so what other indicators, very quickly, Logan, besides the inventory report of 6 months, should consumers be wary of in looking at how real estate can be impacted by an economic slowdown?
Right now, there should be 2 indicators people should look at this stage of the economic cycles. That's leading economic indicators. It's forecasted every recession in the past 6 decades. Right now, it's flat. It's an indicator with 10 different categories in it. If leading economic indicators fall straight for 4 to 6 months, and housing starts fall within a year, that is a noticeable red flag for a recession. Both right now are not doing great, but they're not flagging a recession right now. So if you're concerned about a recession, I would just focus on those 2 data lines right now to keep it simple. And then, if you see declines year over year in leading economic indicators and housing starts, then we could start talking about a recession. But until then, this cycle could go on for another 2, 3, 4, 5 years until those 2 indicators actually start flashing a recession sign.
Logan Mohtashami, thanks for joining us today. You can read Logan's blog, The Financial Truth, at loganmohtashami.com. I'm Jeff Small, and you're watching The Income Generation. We'll be back right after the break.